Let's get back to that. Inflation rate slowing in July. The consumer price index up 1.7% year over year. Our guest, though, says that the core CPI number is still running hot, and that could prevent the Bank of Canada from cutting rates at its meeting next month. We're joined by Dustin Reid, VP and Chief Fixed Income Strategist at Mackenzie Investments. Dustin, thanks for giving us the time.
Thanks for having me this afternoon. Great to be here.
We'll put up a couple of charts here, if that's okay. I took them from Desjardins this morning. Looking at the overall inflation rate, it is slowing. It's now pretty comfortably below 2%. CIBC says slack in economy is helping to hold down prices. But then we have another chart that points to core inflation, and that has been easing according to Desjardins. Again, a 3-month annualized change we're showing here. But you say it's still high enough, core inflation, that it might give the bank pause?
Yeah, definitely. I think at core inflation at around 3%, whether it's the trim or the median, that's going to cause some concern for the bank. And the reason I say that is because the bank believes, rightly or wrongly, with its own academic literature and research, that headline inflation will lean towards the direction of where core inflation already is. So the bank, at least internally, probably has a bit of a bias that at some point, and it's not necessarily next month or 2 months from now, but over the medium term, let's say, there will be a bias for headline to follow core. So there is that concern probably within the bank.
And what is keeping core high? I know there was a turn-up in the latest month in shelter costs, even though the rate of inflation had eased previously.
That's right. Shelter has definitely been a significant component of that. Really, core has been, I think, higher because of a lot of things. Almost all sectors have really contributed to the higher core rate at one point or another over the last 6 to 12 months. So you're seeing that somewhat broadly based inflationary pressure within the Canadian economy, at least as seen by the bank.
And is it tariffs? Are they the main story? That's both tariffs that Canada's imposing on imports and also just general disruption to supply chains?
I think there's some of that happening. I think the tariff story is a bigger driver for inflation in the U.S. than it is for Canada. But I do think that there is some tariff-related inflation pass-through happening on the Canadian side too. But again, if you thought it was happening in size, then it should also probably be showing up on the headline side, and it's not showing up too much on the headline side.
How are you handling things? I was looking at one of your big bond funds there, and a negative return over 5 years, in line with its benchmark. I mean, if you look at 5 years in the bond market, a lot of people are negative. It's been a tough time. How are you handling your bond investments right now?
The big trades we have on in the macro space and in our core and core plus funds, which are our 2 largest funds, are generally spread trades. Looking for spread narrowing between U.S. and Canadian duration. So U.S. yields lower, Canadian yields higher, and in the longer end, the 10s or the 30s space. And similar spread compression on the U.S. and European side, particularly Germany. So again, U.S. duration yields lower, and European duration or German duration yields higher. Those are the big active trades we have on. But we also have some EM trades on that also pick up on this very healthy carry environment, particularly in Mexico and Brazil and South Africa.
Now, you guys in the bond market, you have your own language. Give us that again, Dustin, if you would. Your call on this spread trade is that U.S. bond yields will do what?
So U.S. bond yields lower, Canadian bond yields higher.
Oh,
so that spread, that differential compresses, as we would say.
That's interesting. Would Canadian bond yields move up because of concerns over inflation?
So we think that the Canadian story is very interesting. There's a couple things driving it. One, we, like many, are awaiting the budget. We think it will happen in October and what it will look like. We think it will be relatively spendy. And so we think that that's probably not constructive for the back end of the Canadian curve. So people selling the back end, so prices lower, yields higher. And so that's one of the larger drivers. But we also think that the Canadian economy here is a little bit sluggish. Whether you look at particularly the labor market side, and I would say I'm a little more dovish than where the market is in terms of the Bank of Canada for the rest of 25. I expect that the bank will cut at least once more, if not twice, before year end. So we could see a bit of a steeper Canadian bond curve. So yields at the front end lower, yields at the back end higher. And that's one of the reasons for the spread trades that we have on.
You're not necessarily projecting an interest rate cut, though, next month by the Bank of Canada?
Not necessarily, but we think that the labor market story is important. So with markets only priced about 9 basis points here, something very odd would have to happen for the bank to cut in September. We think it's more likely that the Q4 meetings, October and December, are more likely. And I think 2 is obviously more difficult than 1, but I think the market this year generally has been underpricing the BOC's resolve to cut rates, and I think that MO still resides in markets.
I was talking about the Mackenzie Canadian Bond Fund. You're not. I don't think that's one of the main funds that you're involved with. But yeah, negative return over 5 years, in line pretty well with its benchmark. So it has been tough to own bonds. Why is that? So yields did move up. People were worried, obviously, about inflation in the post-COVID period.
Well, generally speaking, for what we would call real money accounts, they're generally long only, although we have the ability to go short as well. So if you're long only, then you're generally buying, right? So prices higher, yields lower. So in a rising yield environment for real money asset managers, that's a slightly more challenging environment to make money. In addition, when you think about curve shape, curve steepeners are also difficult because it's more difficult for real money managers to buy short end of the curve than long end of the curve because of the duration. So generally, long only managers do better in a flattening yield curve environment as opposed to a steepening yield curve environment.
Yeah, and it's easy to forget how horrible 2022 was. Lots of bond portfolios down more than 10%. Yeah, thank you very much indeed, Dustin, for joining us.
Thanks for having me.
Dustin Reid, VP and Chief Fixed Income Strategist at Mackenzie Investments.